So there's really one reason that someone would consider an early exercise, and that is the potential for tax savings, and sometimes major tax savings, by shifting their taxable gain more towards that long-term capital gain bucket and less for short-term capital gains or ordinary income. The other main reason is to start the clock on qualified small business stock, that 5-year holding period, and then, of course, for the long-term capital gains holding period, either non-qualified stock options or ISOs. So incentive stock options are most commonly known for their tax benefits. However, when it comes to what vehicle is the best one for early exercising, it's not usually ISOs. And it's because of that holding period that we discussed earlier, that 2-in-1 holding period. So in addition to that, there's also a limit on how many, the value of ISOs that can be considered exercisable in a year before they become non-qualified stock options, and that there's a $100,000 limit. So if you're given a big grant, it just wouldn't qualify if there are those early exercise provisions, which is another thing to be aware of. Unlike ISOs, non-qualified stock options and restricted stock awards, you only need to hold those for 1 year to get long-term capital gains tax rates. So we've had clients where we've actually suggested they request this type of equity comp instead of ISOs if they are looking to do an early exercise. And sometimes companies will work with you on that. As mentioned earlier, it has to be permitted by the plan. Not all stock option plans allow for early exercises. And making an 83B election is a really, really key part of this strategy. As we discussed earlier, the 83B election is you officially telling the IRS that you wish to recognize income on this exercise when you aren't vested. So it kicks off this whole process of cementing the holding periods that are really important. There's a strict filing deadline for the IRS. It's 30 days after exercise. You can't be late. It's just non-negotiable. So don't forget about that. But without that 83B election, you don't actually start to have the clock tick on that long-term capital gains tax treatment. And it actually can have some pretty adverse consequences in terms of when income is recognized, which we'll get into in the next couple of examples. So here again is we have several very, very simplified, very hypothetical examples. We're not even using cumulative values here because there's just so many complexities at play that could happen with the rest of your tax situation and specifics of the different grants. This is just designed to give you an idea as to why you might want to do an early exercise and the power of an 83B election. So in the next few examples, we're going to use a lot of the same initial assumptions. The strike price is $1. The 409A valuation of those shares at the time that you do the early exercise is also $1. So if we have ISOs and we've done an 83B election, we're doing an early exercise using those facts, the AMT income at this point is 0 because the spread between the strike price, the purchase price, and the current value of the shares is 0. So this particular grant has a 2-year vesting. Half of it vests after the first year and the second half vests after the second year. So now let's assume we're in year 1. The valuation of the shares is $3. There's no tax impact at this point because we're not selling anything and we've already done the 83B. Fast forward year 2, the valuation is now $10 a share. So now at this point, the qualified holding period will have been met on all of these shares because we're 2 years from grant and at least 1 year from that exercise date. So again, the minimum holding period of time in this example is 2 years. Let's just assume we sell at this point for the same price, $10 a share. So at this point, there's a long-term capital gain on the shares, which is calculated very simply. We just have the price that you sell it for minus the purchase price, which is $1. So it's a $9 per share long-term capital gain. Now let's look at what would happen if we also had ISOs, but we did not do a timely 83B filing. So now there's no tax implications at the early exercise because you haven't officially recognized that income. However, in year one, when the first half of the shares vest, now you do recognize AMT income, and that is on the spread. So because the new 409A is $3 and we didn't file the 83B back when we early exercised, as the participant, you would be subject to recognize AMT income for whatever that value might be once the portion of those shares vest. So this can create a lot of headaches for people, especially if there's no liquidity and if the AMT is actually triggered and tax is due. The other thing to keep in mind is that when you have incentive stock options, if there is an AMT spread, you do have AMT income and you trigger it, you actually can have a dual cost basis that emerges. And that's just something that you'll want to work with your tax advisor and financial advisor on to make sure that you're tracking. But as discussed earlier, the differences in the cost basis can be significant under that regular system and under the AMT system. So in this example, if we're assuming that this individual did actually have to pay AMT in year one, their cost basis under the AMT calculation would be $3, and their cost basis under the regular system would be $1. And this will come into play in year three when there's a sale, because once again, you'll need to calculate your subsequent gain or potentially loss. But here we're using a gain under both tax systems, because AMT is a prepayment of tax. You might actually end up reducing your gain later on. So now in year two, once again, the 409A is $10 a share. And once again, you have triggered AMT income on that spread because it is vested and you didn't do the 83B. So at this point, you have met that qualifying disposition holding period for the ISOs. But that is only for the shares that have vested in year one. Because remember, without the 83B, you don't actually start the clock ticking until the shares vest. So now you need to hold the shares for 3 years, an additional year, in order for 100% of them to qualify as a qualifying disposition. So now in year three, once again, we sell for $10 a share. We're just using that same value throughout here for simplicity, as this is a hypothetical simple example. And again, we have now two cost basis calculations. So if you did have to prepay tax because you were subject to the AMT, you might have an AMT credit. There might be a carryover, and you can use that potentially when you do sell the shares to maybe eliminate a taxable gain that you have, maybe reduce it. But again, those are subject to limitations. So you would need to have a regular tax bill that is higher than your AMT tax bill to even use any AMT credit. And then, of course, you would be limited to the gap between what you'd owe under the regular system and the AMT system, and have a limitation of what that carryover is. So it gets really complicated really fast. There are strategies around planning which lot of shares to sell when, to accelerate the use of that credit. This is a whole nother webinar in and of itself, but just something to be aware of and certainly talk to your tax and financial advisory team about. So now let's go to a non-qualified stock option example. We also early exercise, and here we're assuming that we've done the 83B. And just to note, if we had done the same thing, but with restricted stock awards in this example, the same tax treatment would follow. And again, just as a reminder, you cannot do an 83B election or exercise at restricted stock units at all. This wouldn't apply there. So we have the same figures here. Again, when you exercise restricted stock and non-qualified stock options, it does trigger regular income, payroll taxes, Medicare on the spread. This is an example where it might make sense to early exercise because the spread is zero. So this is a benefit. We don't have any AMT considerations to worry about because we're not dealing with ISOs here. So after year one, now we've met that long-term capital gains threshold for the half of the shares that have vested now. So that's terrific. you don't have to wait quite as long. Year 2, now all of the shares meet that long-term capital gains tax treatment, and we're actually able to sell for 100% long-term capital gain without ever having paid regular income tax on this transaction. So this is a prime example of when it might make sense to consider an early exercise when the taxable spread is low or zero, and the cash outlay to actually purchase the shares is also very low and manageable as well. Of course, if you had 500,000 shares or something like that, that might be a little bit expensive, but we work with clients all the time that might have a penny as a strike price. So that, again, makes it risk adjusted, could make a lot of sense. So what are some of the pros and cons of an early exercise strategy? Again, the potential for big tax savings rather than exercise when the gap is $9 a share. If you can exercise when that taxable spread is $1 or nothing, it really can be a tremendous savings. Again, it starts the holding period for not only long-term capital gains, but Section 1202, which is called qualified small business stock. We will get into that in the next couple of slides, but it's an incredible part of the tax code that is little known. One silver lining to down markets is it can actually reduce that taxable spread. So if you have a down round in this example, where now the 409A isn't $10 a share, but maybe it's $7, well, that can reduce, again, your tax impact. But it's not without risks, right? So leaving the company is one of those risks. The company is actually able to repurchase those shares from you at terms that aren't very favorable to you. So it's usually the lesser of your purchase price, the strike price, or the value of the shares at that time. And if you did make that 83B election, as is common, there's no refund on that tax paid. So you, again, need to keep in mind what your value at risk is in terms of your purchase price and the taxes paid. Mergers and acquisitions, not something that you can control, but that can screw up your plans, essentially. It can trigger a disqualifying disposition of ISOs. It can trigger short-term capital gains, restricted stock or non-qualified stock options. So it's just another thing to be aware of before you decide to do this or not. Stocks don't only go up. We for sure have seen that in the last couple of years, but shares can go underwater, especially if you aren't an early employee with that strike price under $1. We've very much seen it happen where individuals early exercise and now all of a sudden the value is lower, or they are just holding on to the stock and the value is still lower, so those shares aren't worth anything because they're underwater. If you did go ahead and early exercise and those shares become underwater, if the company decided to do something like a repricing to make sure that those equity incentive options still had value because they're trying to be golden handcuffs, they're trying to be trying to have employees stick around. If they end up repricing them to sort of fix that problem, you won't be able to participate because you already exercised. Again, there's always an uncertain path to liquidity and an unknown outcome for the stock. So it's just not reasonable to assume incredible growth rates over time. But it can be a really great strategy in all the right situations.